Shall I start, Ashokji? Shall I start, Ashokji? Hello. Okay, thank you. Good morning, everybody. I hope everybody has joined in. I'm just waiting for 30 seconds so that whoever is joining can join and we can start. Okay, so let's start. To quickly introduce myself, I am CA Abhinay Gupta. I carry 16 plus years of post-qualification experience. And I would be, taking up the today's session on India's 36 revisionary session. So we will dive into practical aspects of this standard. We will be doing some numericals around this so that we understand the practical application of India's 36, right? But before we start with the practical numericals, let's quickly rewind what all we have learned so far under India's 36 and what are the key concepts of India's 36, right? Okay. So as you know, India's 36, revolves around the impairment of the assets, right? So what do we mean by the impairment of assets? And which all assets we are talking about to be covered under this standard, within the scope of this standard, which would be tested for impairment. And if there is an impairment, then the loss will be recognized. So what is the impairment of assets and when it occurs? So let me quickly see the chat box. You can write whatever you want to say in the chat box. Okay. So impairment of assets, whenever we talk about the impairment of assets, right? So what we are talking about, whether, the assets are carried at their recoverable value in our balance sheet or not, right? So if the assets are carried at more than the recoverable value or the recoverable amount of the asset, then it means they are inflated, right? As compared to what the entity would ultimately recover from those assets, right? So they are carrying at inflated value or the higher value as compared to the recoverable amount, right? So in that case, whatever the amount, by which the asset is, carrying at the higher value as compared to the recoverable value would be regarded as the impairment loss. And the standard says this loss needs to be recognized immediately, right, into the profit and loss account, right? So that's what the basic principle of the standard is, right? Okay. Uh, just give me a second. Okay. So impairment means when the assets, are carried at value which is higher than as compared to their recoverable value, then we would be recognizing the impairment loss. That is the difference between the carrying amount and the recoverable amount of that very asset, right? So that's the basic concept, right? Yes, Aminata. Now, how do we determine the recoverable amount? The next question arrives because the carrying amount we certainly know. We can look at the balance sheet and we can know what is the amount at which the asset is being carried, right, on a particular reporting date. But how do we determine the recoverable amount? So, what is the rule book around that? What the standard says? How we are going to determine the recoverable amount? So I will take 30 minutes to revise all the key concepts and then we will start doing the numericals. So that's the plan for today. So fair value loss less cost to sell or the value in use, whichever is higher, right? So that's the concept. That's the standard as given the guidelines, right? To recognize, to determine the recoverable amount or recoverable value, right? Now, when we say the fair value less cost to sell, okay, let me park value in use for the time being. Let me talk first fair value less cost to sell. What do we mean by the fair value? So cost to sell I will come later. What we mean by the fair value? So fair value would be determined in accordance with the fair value standard, that is the Ind AS 113 fair value measurement. I hope you are able to recall whatever you have learned in that standard, right? So that standard gives a definition of the fair value, right? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants. Correct? So this is the definition given by the standard 113. Now, within this definition, there are crucial words in an orderly transaction between the market participants at the measurement date, right? So it means fair value is the value which is determined from the perspective of the market participants and it is not the entity specific value. Are you agreeing with this? Right? That's what we have learned under Ind AS 113 when we determine the fair value. So fair value is always determined from the perspective of the market participants and not from the perspective of the entity or the person who is holding the asset, right? Number one. Number two, fair value is determined on a particular measurement date, right? So we can say that this is the fair value on this date for this asset, right? So although there might be insignificant changes for next 3 months, 6 months, or 1 year or 2 years, depending on the nature of the asset, and the same fair value can be assumed to be the fair value of that asset throughout the year, but still the standard says fair value is determined on a particular measurement date, right? And the third key words in that definition is the in an orderly transaction, right? So the transaction which determines the fair value should be an orderly transaction and it should not be a disorderly transaction. What do you mean by disorderly transaction? That is, the transaction is not forced, it is not done under some coercive practice, or it is not done when the entity was in the dire need of the funds and they eventually sell the assets to realize the cash, right? So all those forced or liquidation transactions should be avoided to draw the reference of the fair value of the asset, right? So that's what the Ind AS 113 says. But for our standard Ind AS 36, because we are going to determine the recoverable amount, and the recoverable amount as per the standard is the fair value less cost to sell or the value in use, whichever is higher. So fair value we have to determine in accordance with 113. That was I was explaining. Now, the next part is the cost to sell. What do we mean by the cost to sell, and which all cost will qualify for the cost to sell and which all costs will not qualify for cost to sell? Any examples? Yes, any example? which cost will qualify for cost to sell? Dismantling cost. Okay. And any example of the cost which will not qualify for the cost to sell? Yes, one example of a cost which will not qualify for the definition of cost to sell. Advertisement to sell. Perfect. Perfect, Samanathan. So from these two examples, what the meaning we are able to derive? So the cost which will be incidental to make the sale happen will be regarded as cost to sell, and all other costs apart from these incidental costs would not be regarded as cost to sell. Is that what we can draw? Right? So the costs which are incidental to make the sale happen are regarded as cost to sell. For example, dismantling cost, right? But any advertisement or marketing practice run to identify the buyer wouldn't be treated as the cost to sell, right? So we will do the numericals. We will further touch upon on these aspects. The next item is value in use. Now, what do we mean by value in use? So value in use means the value the entity will realize over the period or over the useful life of the asset by using the asset in its business. Correct? That's what value in use means. Right? So what the value the entity will ultimately be able to realize by using the asset for its business purposes, that is called the value in use. Right? Now, how do we determine that? So the concept is we determine the first of all free cash flows, right? Whatever the free cash flows the entity will be able to generate by using this asset in its business, right? Once we are done with the determination of the free cash flow over the useful life of the asset and the ultimate terminal value which we will be realizing or fetching from the sale of the asset at the end of the useful life, right? So all those values are to be discounted at a appropriate discount rate, correct? And then we will determine the present value. That present value would be regarded as value in use as on today for this particular asset, right? Now, how do we determine, number one, the free cash flows, and number two, how we will decide at what rate this needs to be discounted, right? The question arises. So we understood the concept that we are going to apply the discounted cash flow method, DCF method, right? But what do we mean by the free cash flows? So what do we mean by free cash flows? So free cash flows basically needs to determine over the useful life of the asset, that is whatever the cash we will ultimately be realizing by using the asset, right? So standard gives certain guidelines around what to be included and what to be excluded from these determination of the future cash flows, right? So what are those? Projections of the cash flows from the continuing use of the asset, right? So whatever the asset we are using, so we believe that we will continue to use that asset over the useful life, and whatever the cash inflows we will be able to generate by using that asset, that is whatever the product we are going to manufacture by using this asset, and then ultimately those products will be sold into the market, right? So sales price into my quantity is equal to sales value minus cost of goods sold, right? All the direct indirect expenditures, right? Then we will derive somehow the cash flows, right? Projection of cash outflows which are necessarily incurred to generate the cash inflows from continuing use of the asset. So whatever the inflows we are going to receive and minus whatever the outflows we are going to incur over the period, right? So net cash flows to be received or paid for the disposal at the end. So first of all, cash inflows minus cash outflows and plus whatever the net cash inflow or outflow which we will realize as the terminal value of the asset at the end of the useful life, right? So all these items we need to populate in a spreadsheet or the Excel, right, over the years. And then what we need to keep in mind that we are not going to include future restructuring. What do we mean by future restructuring? Any idea? So if the entity says that because the technology is changing, we might be, planning to purchase some new technological equipments, right? Or new machineries so that our production capacity gets more efficient. It produces more output as compared to what we are doing or producing today, right? So this is the plan. Now, basis on this plan, should we assume that yes, the company is going to incur this expenditure, they will modernize their plant and factory, and they will ultimately bring in more efficiencies and the more production will happen. So let's capture all that. And basis on the revised production, the revised number of sales needs to be captured for the cash inflow. No. So standard prohibits. Standard says we shouldn't be considering any future restructuring plans which are in the head of the management and not on the ground. Right. So unless and until something is really executed, we are not going to consider the plans. Right. So plans are always plans. They are not the reality. Right. So that's what the standard says. So standard says we should be considering only those things which are visible on the ground, right? Rather than the future expectations or future plans of the management, right? So generally management plans that after 2 years we will do that, after 5 years we will do that, but most of the things don't get executed for some or other reason, and hence standard prohibits to factor into any such assumptions, plans, or future expectations into the calculation of the free cash flows. Is that clear to everybody? Perfect. Improving or enhancing the assets performance, cash inflows or outflows from financing activities, and the income tax receipts or the payment. So all these items needs to be excluded while calculating the free cash flows. Now, once we are done with the calculation of the free cash flows, right? Now, what do? We should decide upon at what rate we are going to discount this, right? So what that rate would be and how that would be decided. So standard gives a bright lines on this. So standard says entity's weighted average cost of capital. If that is not available, entity's incremental borrowing rate. If that is also not available, other market borrowing rate, right? So whatever the borrowing rate prevailing in the market in general, right? So first preference one is the entity's weighted average cost of capital. Preference two is the entity's incremental borrowing rate. Preference three is the general borrowing rate in the market. Is that clear? So weighted average cost of capital, I can safely assume that you know how to calculate, right? So if the company has the equity or the debt or the both, right? So it has to be a weighted average cost of capital, whatever the cost of capital the company is, having basis on the debt equity mix, right? If the company does not have any debt, then certainly there wouldn't be any weighted average cost of capital. In that case, incremental borrowing rate would be the advisable rate which the entity should use for the discounting, right? Now, how do we determine the incremental borrowing rate? So basically, it would be the rate at which the company will be able to generate loans from the lenders or the bankers, right? So that would be regarded as the incremental borrowing rate. And if that is also not available, then whatever the rate in the economy is generally prevailing for the or offered by the banks or the lenders to the similar sized entities or similar nature entities, right? So that general borrowing rate we can consider. Now, once the rate is decided, simply you need to calculate the present value of the cash flows, which you have calculated in the step one, right? Once you calculate the present value, this present value would be regarded as the value in use. Now we do have two values. First is the fair value less cost to sell and the value in use. Now, whatever is higher, whichever is higher among between these two values would be regarded as the recoverable amount. And that recoverable amount will be matched with the carrying amount of the asset in the balance sheet. And if the recoverable amount is higher as compared to the carrying amount, what we are going to do next? Right. So comparing with the carrying value, if the recoverable amount is high as compared to the carrying value, so what next? So if my recoverable value is say 150 and the carrying value is 120, what we are going to do next? Gain. So are we going to record the gain? No. So that's the mistake, most of the people do here. So this standard is only concerned with the impairment loss, right? So if the loss is coming up, then the journal entry will be required to be recognized for the impairment loss. But if the loss is not there, we will simply ignore any accounting at this stage, right? So under Ind AS 36, it can never happen that if there is no impairment loss or basically there is a positive loss, right? Because impairment gain is not the word anywhere in the dictionary of the IFRS or Ind AS, right? So we wouldn't be saying impairment gain, but because our recoverable amount is higher as compared to the carrying amount, so there is certainly a gap between the value, right? So that gap we are not going to recognize in our books. Is that clear? Okay. Now Samanathan is asking, so in case the company had opted for the revaluation model, then what we are going to do, right? So in that case, company will again perform the revaluation exercise, right? Which is different from the impairment exercise, right? So under the impairment exercise, we are comparing the two, items, that is the fair value less cost to sell and the value in use, whichever is higher. And basis on that, we are trying to match up the carrying amount, right? But when we do the revaluation, we don't calculate the value in use. We don't calculate the cost to sell. We only calculate or determine the fair value, and we compare the fair value with the uh, carrying amount, right? So that is a different exercise. So whenever you are performing any impairment workings, and if on basis on those workings, there is a positive impairment loss, that is recoverable amount is greater than the carrying amount, no accounting entry will happen, even if you had opted for the revaluation model. Is that clear, Saminathan? Perfect. Okay. Now we recalled how we are going to determine the impairment loss, right? But under what situations we should go ahead and determine or perform the impairment testing? What are those situations which demands us to do or work upon on the impairment workings. What are the guidelines given by the standard on this? Are we going to do this every quarter? Are we going to do this once in a year? Are we going to do this once in a 5 years or what? Once in a year? Okay, does the standard say so? Reporting date? Okay. But what the guidance the standard has given on this? Whether the standard requires you to do it every year? What is the guidance or the principle of the standard? No. So the standard says that impairment testing has to be performed whenever there are indicators. So if there are no impairment indicators, you are not required to perform the impairment testing unnecessarily, right? So there is no rule to do it every year or to do it every reporting date, right? So no, there is nothing like that mentioned under the standard. So standard simply says, as and when there are indicators, you need to perform the impairment working, and basis on the impairment working, if there is an impairment loss, you need to recognize that. Is that clear? Now, there is one exception to this rule. In case of intangible assets with indefinite useful life or intangible assets which are not yet developed, or the goodwill. So for the goodwill, for the intangible assets with indefinite useful life or the intangible assets which are not yet developed, the rule is to test for impairment every year mandatorily. So it is not for all the assets, Saminathan. It is only for these three specific assets which I have just mentioned, right? For all other assets, it is not once in a year or at the reporting date. It is as and when the indicators are there. Is that clear? Perfect. Now, what do we mean by indicators then? The question arises, right? So there are certain examples of indicators which are given by the standard. So this is not the complete list. This is not the exhaustive list. This is the suggestive list. Just to make you understand what do we mean by the indicators of for impairment. For example, all these indicators are divided into basically the two categories. One is the external indicator and another is the internal indicator. What do we mean by the external sources of information or external indicators? That is significant decline in the market value, more than normal decline. So there might be chances or there might be, situations where you might have seen that the market value, that is the market capitalization of any listed company, right? In case the company is listed, is significantly lower as compared to their book value, right? So if this is the case, then it means investors are just discounting on the company. So they don't see whatever the book value of the company is as the true value of the company. And hence, because of this, there is a significant decline in the market cap of the company as compared to the book value, right? Because investors are not liking this company, right? So they are not investing, they are rather selling the company in the market, right? Company shares in the market. So because of that, market capitalization is significantly lower as compared to what the company's book value of the assets represents, right? So it means there is something lousy about the true value of the company's assets, and hence it means there might be a chance that the company might need to work upon on the impairment testing for its assets, right? Changes in the technology. So company was into a business and it was using some machineries or the technology which is now becoming outdated or obsolete because altogether new machineries, new advanced technology has already arrived in the market, and because of that the company's plant and machinery will become redundant or outdated, right, as compared to the new technology. So there is a chance that it might be impaired, right? So it doesn't mean that if these indicators are there, impairment has to be there, right? So whether there would be an impairment loss or not, that we will, come to know only upon the working of the impairment testing, right? But these indicators ask you or demands you that you should perform the impairment working. Is that clear? So these indicators are not saying there is an impairment loss. These indicators are only asking you to work upon on the impairment testing so that you can conclude whether there is an impairment loss or not, right? So in spite of these indicators, there might be a situation where there is no impairment loss because our recoverable amount is not lower than the carrying amount, right? So if that is the case, then in spite of having these indicators, we are not going to record any impairment loss, right? So indicators by itself doesn't mean impairment. Indicators only ask you that you please go ahead and perform the impairment testing, right? Increase in market interest rates. So whenever the interest rates in the economy increases in general, what does this mean? So if the interest rate rises, the discount rate will also rise, yes or no? If the discount rate increases, the present value decreases, yes or no? Because there is an inverse relationship between the discount rate and the present value, correct? If the discount rate increases, present value decreases, right? And because of the increase in the interest rates, my discount rate will increase, and hence it will result into the lower present value, that is the lower value in use, right? So there might be a possibility that impairment loss might be triggered, right? So this is one of the indicator only, right? Not the conclusive factor of recognizing the impairment loss. Then the next is the carrying amount of the net assets of the equity entity is more than its market capitalization. That the same thing which I was discussing before. So these are kind of external sources of information or external indicators. Let's talk about certain internal indicators. Obsolescence or physical damage of the asset. Fire broke out in the factory and damaged certain machineries. Impairment possible, not possible? Correct? Because the fire has damaged certain machineries plant. It has stopped the production as well, or it impacted the production. So whatever the machineries or the production line is affected will be tested for the impairment. Yes. Significant changes in use or expected use of the asset with adverse effect on the entity. So there might be certain changes in the use of the asset or expected use of the asset, which is resulting into the lower efficiency for the entity. So impairment indicator, yes. Internal reporting indicators indicating worse economic performance of the asset than expected. So asset has started diminishing in its efficiency. What does this mean? Again, impairment indicator, right? Okay. So these are the internal and external indicators. Now, if I say that if you have subsidiary on your balance sheet, on that subsidiary as well, you need to check the impairment testing. Yes or no? Investments in subsidiaries, investments in joint ventures, investment in associates. Are these items required to be tested for the impairment? Yes. Now, what are the indicators when they should be tested? So some indicators are given around that as well. For example, carrying amount of the investment, that is whatever the amount the company has invested in its subsidiary, JV or associate in its standalone balance sheet, which is showing up as investment in the subsidiary, investment in JV or investment in associate, is greater than the carrying amount of the assets or net assets of that investee, right? So if subsidiaries assets value, net assets value is lower than the investment value in the parent, then it means there might be an indicator for the impairment. Yes. Right. Same thing for JV and associates too. Right. Or dividends received from the subsidiary, JV or associates are greater than the total income or total comprehensive income of that very subsidiary JV or associate. So it means they are distributing the capital as well, not only the profits. So it means there might be a possibility of impairment on these investments, right? So these are the key concepts I thought to rewind. Now let's start some practical questions. I hope you have the writing pad, pen, and calculator ready, right? Okay, once the screen is up, please confirm to me. I'm increasing the font size in case somebody is attending this class from the mobile so that they can see the font size clearly on their mobile screen too. I hope the font size is good enough, right? Perfect. Thank you. Okay, so let's do the first question. ELA Limited is a manufacturing company, right? Manufacturing company which deals into the manufacturing of the cold drinks and the beverages. It is having various plants across India. There is a machinery A in the Baroda plant, which is used for the purpose of bottling, right? So machinery A, Baroda, and bottling, right? There is one more machinery B, clubbed with machinery A. So machinery B is clubbed with machinery A. Okay. So are we noting the facts carefully? Okay. Machinery A can individually have the output. So machinery A can produce the output on its own, right? And also sold independently in the open market. Machinery B cannot be sold in isolation and without clubbing with machinery A. It cannot produce the output. So machinery A can produce the output which can be sold in the market independently, but machinery B can only be used in conjunction with machinery A and cannot be producing any output independently without machinery A. Is that clear? So machinery B is a ancillary machinery to machinery A and dependent on machinery A. The company considers this group of assets as the cash generating unit, right? CGU, machinery A and machinery B together. And in this CGU, there is also inventory amounting to rupees 2 lakh, goodwill 1.5 lakh is also present. So what is the CGU? CGU is the smallest cash generating unit, right? Why do we identify CGUs? Because when one machinery is not able to independently produce output and hence we will not be able to compute the free cash flows. So we need to see what is the smallest group of those assets which can produce output and generate the cash flow, right? So basis on those group of assets, CGU is determined, and that's for that CGU, we perform the impairment testing, right? This is all you know already, right? Now, in this CGU, there are 4 items: machinery A, machinery B, inventory 2 lakh, and goodwill 1.5 lakhs, right? Machinery A was purchased on 1st of April 2003 for rupees 10 lakhs and the residual value is 50,000. Machinery B was purchased on 1st of April 2005 for 5 lakhs and the residual value is 0. The useful life for both the machinery A and machinery B is 10 years. The company expects following cash flows in the next 5 years. Pertaining to the machinery A, the incremental borrowing rate of the company is 10%, right? So these are the facts given about the machineries and the CGUs, along with the incremental borrowing rate given in the question at 10%. Now, being determined on 31st March 2008, the fair value determined is 7 lakh, right? The valuation fees paid to the valuer is 1 lakh, and with Ind AS 2, the recoverable value of the CGU is 10 lakhs as on 31st March 2008, and combined machinery A and B is 7,60,000 as on 31st March 2009. So these are the additional piece of information about the recoverability and the carrying value of each asset after charging impairment loss for the year ending 31st March 2008 by providing all 9 on the above assets and compute the carry requirements, and the questions is carrying 10 marks. So I can wait for, but I just write. If you don't try, then probably you will never know what, was the mistake you could have done, right? So giving you 3-4 minutes to try it quickly, and then we will see or discuss the solution in detail along with the concepts covered by the question. Sorry. I was just asking, any luck with the answer? What is the amount of the impairment loss? So Samanathan is saying carrying value is of machinery A is 525. Okay. Manish is saying 66316 for A. Okay, you mean to say impairment loss. And carrying value of machinery B is 3,50,000. Okay. Okay. So assuming you have tried, right? So let's discuss the solution. Value is 489,650. Okay. Perfect. So let's see. So first of all, what we will do? We will do the presentation for the computation of the impairment loss and the carrying value of each of the set in the CGU after the impairment loss, right? So that was the ask from the question. So our presentation should be in the same order in the which the question is asking us to provide, right? The various requirements. So first ask was the what is the impairment loss and the carrying value of each asset after the impairment loss is recognized within the CGU, right? So that is the first task. So first of all, we will calculate the carrying value of the machinery A and B before the impairment. Then we will apply the impairment loss and then we will compute the carrying value after the impairment, right? Okay, so impairment loss as per Samyanathan is 35,350. Okay. Okay. So the cost is given in the question 10 lakhs for the machinery A, for which it was purchased initially. Residual value given in the question 50,000 at the end of the useful life, which will be realized. Useful life for asset is given 10 years in the question, right? And the useful life already passed on as on the today's date is 5 years, right? So first of all, we will calculate the yearly depreciation. How do we calculate yearly depreciation? The cost minus residual value divided by the useful life. So 10 lakh minus 50,000, that is 9 lakh 50,000 divided by 10 years. So 95,000 would be the yearly depreciation. Since 5 years has already lapsed by now, so 95,000 into my 5 would be deducted from the value, right? So what it will give you 5,25,000 as the carrying amount before impairment loss for the machinery A. I hope we are good to go at least on this number, right? 5,25,000. Too simple to calculate. Same lines, machinery B. So machinery B cost is given 5 lakh, residual value is given 0. In the question, useful life is same, the 10 years, and the life already expired or lapsed is 3 years. So 50,000 would be the depreciation. 50,000 into my 3, 1,50,000 would be the depreciation, which would have been provided by now by the company. So 5 lakh minus 1,50,000, 3,50,000 would be the carrying amount of the machinery B as well in the books as on date. Is that clear? Right? Now, calculation of the value in use for machinery A. So for machinery A, the cash flows are given in the question, right? So using those cash flows and the discount rate 10%, which is also given in the question, that is the incremental borrowing rate, we can calculate the present values, right? So, and since in the question, it was specifically mentioned that residual value is not considered. So we will add the residual value which we will realize at the end of the 5 years, right? From now, because 5 years have already lapsed. So 31,050 we will also consider. So hence the present value is coming up to 489,650. Correct? So this is the value in use for the machinery A. 489,650. Simple two things. The cash flows are given in the question. Discount rate is given in the question at the rate 10%. We have simply calculated the present value. That's all. Nothing complicated, right? The only thing which we have kept in mind is the residual value, which was specifically called out in the question, that the free cash flows doesn't consider the residual value or excluding the residual value. So residual value we have added, right? Because at the end of the day, it will also be realized. So it has to be considered in the cash flow calculation, right? So 50,000 we will also realize at the end of the useful life, right? Now, calculation of the fair value. Less cost to sell for the disposal of the machinery A. So fair value is also given in the question 7 lakhs, right? If you have read the question carefully at the last piece of information, right? Dismantling costs were given, cost to sell, packaging costs were given 25,000 and legal fees was given 75,000. So all these three costs form eventually the cost to sell, right? Cost to sell. So once the cost to sell are determined and deducted from the fair value given in the question, you will be able to calculate the fair value less cost to sell 4,50,000. How many were correct in calculating this 4,50,000? Right? So which cost you did not consider as the cost to sell in this question? So let me go back to the facts of the question. So there were certain costs given here. So dismantling cost, anyway we have considered, packaging cost we have considered, and the legal fees we have considered. So the valuation fees of rupees 1 lakh, which was paid to the valuer for determining the fair value, was not considered as cost to sell. Why so? Because this cost has no nexus with the selling of the machinery, right? So fair value was determined of the machinery is a separate, altogether separate activity, right? It doesn't have any nexus with the sale of the machinery. So only those costs which are incidental to make the sale happen will be considered as cost to sell, right? So that's the principle which we have revised and now we have applied in this question, correct? Right. So 1 lakh valuer's fees is ignored for the purpose of cost of selling. Why we have considered dismantling cost? Because without dismantling, can you sell the machinery? No. Why special packaging cost? Without packaging, can you sell the machinery or transfer the machinery or transport the machinery? No. That packaging is required for the safe, transfer or transit of the machinery, right? And the legal fees, without the legal papers, ownership cannot be transferred. So for that, the legal fees has to be incurred, the stamp papers, the lawyer's fees, or whatever the legal charges, which eventually will be paid. All these charges are being incurred if and only if the sale is happening. If the sale is not happening, these charges will not be incurred. And hence, these are very much related to the sale, right? So these three items are cost to sell, correct? Perfect. Let's go down. So we are done with the calculation of value in use. We are done with the calculation of fair value less cost to sell for the machinery A, right? Now, calculation of the impairment loss on the machinery A. So what is the carrying value of the machinery A? 5,25,000, which we have computed in step 1 above, right? Here it is. When we deducted the depreciation for the 5 years, here it is. 5,25,000, right? So this is the carrying amount and the recoverable amount is what? Fair value less cost to sell or the value in use, whichever is higher. So 489,650 versus 450, whichever is higher, 489,650, right? So 489,650 is considered as the recoverable amount and 525 is the carrying amount. So how much impairment loss is there? 35,350. How many were correct in calculating this 35,350? Okay. So 35,350 would be the impairment loss for the machinery A because we do have the carrying value of the machinery, which we have calculated in step 1. We do have the fair value less cost to sell, which we have calculated in step 3 at 4,50,000. And we do have the fair value in use for the machinery A, that is 489,650, calculated in step 2, right? So by comparing the value in use with the fair value less cost to sell, we calculate the recoverable amount, which would be the higher of the two, that is 489,650, which we will be matching with the 525, the carrying amount, and the 35,350 would be the impairment loss on the machinery A. Now, calculation of the impairment loss on the CGU. So why we are not calculating the impairment loss of the machinery B separately? Because machinery B cannot operate on its own. And because of the fact machinery B is not a asset which can be tested for impairment individually, and hence it has to be part of that CGU for which the impairment test we will do. So now we are doing the impairment testing for the CGU as well, right? Or calculation of the impairment loss for the CGU. So for the CGU, first goodwill will be impaired fully, and then the remaining impairment loss of 75,000 will be allocated to machinery A and B. If we allocate remaining impairment loss to the machinery A and B on a pro rata basis, it would come to 45,000 on machinery A. However, the impairment loss of the machinery A cannot exceed 35,350. Hence, impairment of the CGU is to be as follows. So first of all, let's calculate the recoverable value. Sorry. Here it is. So first of all, we will calculate the machinery A, machinery B, inventory and goodwill carrying amounts. So carrying amounts are 5,25,000, 3,50,000. Inventory is given in the question 2 lakhs and the goodwill is 1,50,000. Total carrying value of the CGU is 12,25,000, right? Before the impairment loss. Now, carrying value after impairment loss is determined at 10 lakh, right? And how this 10 lakh is arrived? So that is given in the question. Here it is. The company has done the assessment of the recoverability of the CGU and found that the value of the CGU is 11 lakhs. On 31st March 2009, the recoverable value of the machinery and machinery A and machinery B is given 450 and 760, right? So basis on this, 11 lakh first of all, we will eliminate the goodwill completely. So what was the value of the goodwill? 1,50,000, right? So 1,50,000 is completely eliminated, right? Then inventory. Do we calculate the impairment loss on the inventory? No, because inventory is not the item on which impairment testing needs to be performed. Inventories are measured in accordance with Ind AS 2 at the cost or NRV, whichever is lower, and hence 2 lakh would be the value unaffected by the impairment loss, right? So there wouldn't be any allocation of the impairment loss on the inventory, right? Now, the remaining impairment loss of rupees 8 lakh will be allocated to these two machineries, machinery A and machinery B, right? So carrying value will be calculated after allocation of the impairment loss of the remaining impairment loss, right? Now, what is the remaining impairment loss? 2,25,000 minus 1,50,000. How this is arrived? 2,25,000. So 2,25,000 is the impairment loss on the overall CGU, for which the carrying value is fair value is less cost to sell is given at 7,60,000, right? So out of that 1,50,000 is the allocation on the goodwill, right? So 2,25,000 minus 1,50,000 remaining is how much? 75,000. This 75,000 we need to eventually allocate only on the remaining two items, excluding the inventory, that is the machinery A and machinery B. Right? Now, on machinery A, we have individually calculated the impairment loss, which is how much? 350. So on machinery A, the loss cannot exceed the individual impairment loss which we had calculated under the previous step, right? So we will use that 35,350 and the remaining we will allocate to the machinery B, 39,650. Now, this is the crucial aspect about this allocation which we need to keep in our mind, and what is the learning from here. So the learning from this question is, number one, impairment loss first of all will be allocated to the goodwill. Once the goodwill is completely written off, then if there is any remaining impairment loss, then it will be allocated to the remaining assets, excluding the inventory, because inventory is not the impaired or impairable asset under India's 36, right? Number one. Number two, because the remaining two items, machinery A and machinery B, right, which are supposed to get the impairment loss on a pro rata basis, and pro rata will be basis on their carrying amount, right? So if we calculate the 75,000 divide by 525 divide by 5 और 3 8 75, right? So what this amount comes? Can somebody calculate quickly what this amount comes? 45,000, right? So ideally, if we go by the rule book of the Ind-AS 36, that is the impairment loss has to be allocated on a pro rata. So 45,000 would have been allocated to the machinery A, and for machinery B, it would have been how much? 30,000, right? If I'm not wrong, right? 45 and 30 would have been the ideal allocation, right? Had the individual impairment losses working were not part of this question, right? So this would have been your answer. For machinery A, 45,000, for machinery B, 30,000 would have been the allocation. But because we do have the machinery A individual impairment loss, basis on the facts of the question, because machinery A can produce its own cash flows, and hence impairment testing was done on an individual capacity as well for machinery A. And whatever the specific impairment loss for machinery A, which we had calculated for 35,350, it is the maximum, right? So instead of charging 45,000 on machinery A, we will charge only 35,350 on machinery A and the balance on the machinery B. Is that concept understood clearly? So in the absence of the individual impairment losses, the ideal process or step was to allocate it on a pro rata basis, and pro rata working has to happen basis on the carrying values, carrying amounts on the reporting date before the allocation of the impairment loss, right? But because in this question or in this question, we had some facts about machinery A as well, and we were able to calculate the individual impairment loss of machinery A as well, apart from the CGU's impairment loss. So machinery A's individual impairment loss cannot, so impairment loss on machinery A cannot exceed its individual impairment loss, right? So that is the key learning from this question, which you have to note down somewhere on your notepad for your quick revision during your exam days, right? So these are the remaining notes. After the adjustment of the impairment loss, what would be the revised carrying value, right? So 489, 650 would be the revised carrying value, 310, 350 would be the revised carrying value, and thereafter you will start depreciating again. So my 489, 650 minus 50,000 divided by 5. So this would be the after depreciation. And inventory will continue to be sitting at 2 lakh. Goodwill is 0. So the CGU's carrying value has now 867,734, right? So I hope this question was easy, right? This did not give much difficulty or challenge, right? So Manish is asking if individual capacity of more than 45K, then what to do for machinery A? So you mean to say individual capacity? What do we mean by individual capacity? Impairment loss. So anyways, impairment loss, suppose on machinery A was say suppose 50,000, right? And the allocation is coming only 45,000. Then you will allocate 50,000 only because the individual impairment loss has to be there on the asset, right? Whatever it is, whether it is lower or higher. Correct. So whatever the individual impairment loss you have calculated on a particular asset within the CGU has to be applied on that asset, right? So since in this CGU there are only remaining assets, machinery B. Suppose there is a one more machinery C, then what would the calculation would be? So in that case, what would happen? On machinery A, the individual loss would have been applied and the remaining total loss would have been allocated on pro rata on machinery B and C, right? So this is how you are going to do this. So the rule is if you are able to calculate the individual impairment loss on any asset within the CGU, the individual impairment loss will be applied on that machinery or asset. Is that clear? And the remaining on the remaining assets. Perfect. So let's move to the question 2. And again, I will give you a chance to do this. And I expect you will be nailing it. Okay. E Limited owns a machinery used in the manufacture of steering wheels, which are sold directly to a major car manufacturers. The machine was purchased on 1st April 2001 at the cost of rupees 5 lakh through a vendor financing arrangement on which interest is being charged at the rate of 10% per annum. So machinery is purchased via financing, 10% is the rate of interest and 5 lakh is the cost. And 1st April 2001 is the date of purchase. During the year ended 31st March 2003, E Limited sold 10,000 steering wheels at a selling price of rupees 190 per wheel. So the output the company is producing is the steering wheels. So those steering wheels are sold at rupees 190 per unit and total number of units sold in the market are 10,000, which are produced by using this machinery, right? The most recent financial budget approved by E Limited's management covering the period 1st April 2003 to 31st March 2008, including that the company expects to sell each steering wheel for 200 during the 2003-4. The price rising in later years in line with the forecast inflation of 3% per annum, right? So in the year 2003, unit price was 190, right? And company is expecting to sell each steering wheel for 200 in 2024. So in 2000 X3 it is sold 190, X4 it is being sold at 200. Okay, and X5 and onwards it is being increased by 3% per annum. So 200 into 3%. So 206. Okay, like so and so on. During the year ended 31st March 2004, E Limited expects to sell 10,000 steering wheels. The number forecast is also expected to increase 5% each year until 2008, right? E Limited estimates that each steering wheel cost is rupees 160 to manufacture, which includes 110 variable cost, 30 fixed overhead, and 20 transportation cost. Costs are expected to rise by 1% during 2004-5, then by 2% per annum until 2008. During 2005-6, the machinery will be subject to the regular maintenance costing rupees 50,000. 2003 and 4, E Limited expects to invest in the new technology costing rupees 1 lakh. This technology will reduce the variable cost of the manufacturing steering wheel from rupees 110 to rupees 100, right? And the share of fixed overhead from 30 to 15, subject to the availability of the technology, which is still under the development. E Limited is depreciating the machinery using the straight line method over the 10 years useful life. The current estimate based on the similar assets that have reached the end of their useful life on the disposal proceeds from the selling of the machinery is rupees 80,000 net of the disposable cost. E Limited expects to dispose of this machinery at the end of 2008. E Limited has determined a pre-tax discount rate of 8%, which reflects the market's assessment of the time value of money and the risk associated with this asset. Assume the tax rate is 30%. Determine the value in use for the machinery in accordance with Ind AS 36. So question is looking lengthy to read, but I bet you once you try to solve it, it is very easy. So I'm again giving you 4 minutes to quickly construct the cash flow working. Let me know if I need to move the pages up or down as and when you are able to read it. So just note down key facts. Develop the horizontal columnar presentation on your notepad. Put the years, put the sales number of units, put the selling price, then put the multiplication of the number of units into the selling price so that you don't do any mistakes in the examination hall if you are using any shortcuts. So don't use shortcuts because this question has a different incremental rate for the number of units and the selling price and the cost. So you need to have all the three components lined up on your presentation, right? So that you can quickly calculate what is the selling price across the years, what is the number of units across the years, and what is the cost across the years. And eventually you will be able to calculate the cash flow correctly. If you try to apply the shortcut, there might be a chance to do the mistake unnecessarily. So take some time, do the right calculation. And I tell you, the marks, full marks, if you want, to receive on your practical questions, the best way is to come up with the right presentation as well, apart from the right answer or right calculations. Because if the presentation is messy, then the examiner who is checking your paper might not be able to comprehend how exactly you have done this, right? Or what is, the flow of your solution. And in that case, because he will spend unnecessarily extra time to understand how you derived it, and it will frustrate him, and certainly he will give, lesser marks as compared to the full marks in spite of the solution is or answer is ready or correct, right? So do focus on the presentation as well in the examination hall. Neat and clean handwriting, no cuttings, right? Unless and until there is a need to cut and, overwrite, and the nicely drawn presentation. And it all comes with practice. More you practice on the presentation, quick presentations, ready, handy presentations with the correct referencing to the working notes, it will give you, edge in the exam. If you apply the shortcuts always in the practice at home, you will end up doing a messy presentation in the examination hall. 2 more minutes. Yes. Any luck? So Samanathan has came up with the quantity 10,500, 11,025, 11,576, 12,155. Okay. Price is 200, 206, 212, 219, 225. Okay. on year 7, 8, 80,000 disposable value to be added. Okay. Cost per unit also you have calculated. Then calculate the cash inflows. Then calculate the cash outflows. Then deduct the cash outflows from the cash inflows to arrive at the net cash inflow oblique outflows. And then use the discount rate, multiply the discount rate, and then you compute the present value, right? Okay. So I think uh, 5 more minutes would be, difficult to give. So maybe I hope you're moving in the right direction. It's a matter of calculation piece only now, right? So we can do the rest of the calculation together, but conceptually, you have proceeded in the right direction with the right numbers, I expect, right? So let's do the calculations together. Okay. So first of all, calculation of the value in use of the machinery owned by E Limited includes the projected cash inflow, that is the sales income from the continuing use of the machinery, and the projected cash outflows that are necessarily incurred to generate those cash inflows, that is the cost of the goods sold, right? We will calculate this. Additionally, projections will include 80,000 from the disposal of the asset in 2008. Cash outflows include routine capital expenditure of rupees 50,000 as well in 2005 and 6, right? So these are the piece of information given in the question. Now, as per Ind AS 36, so first of all, we will understand what is the principle. Estimating of the future cash flows shall not include the cash flows from the receivables, payables, or the outflows expected from the future restructuring, or the inflows or outflows expected to arise from improving or enhancing the performance of the asset, or the cash inflows or outflows from the financing activity and the income tax receipts and the payments, right? So all these items Ind AS 36 is specifically prohibited to consider for the purpose of calculation of the value in use, right? Now, hence, in this case, cash flows do not include the financing interest rate, that is the 10%, the tax 30%, and the capital expenditure to which E Limited has not yet committed, that is rupees 1 lakh. They also do not include any savings in the cash flows from these capital expenditures as required by Ind AS 36. I hope this piece of information is everybody is clear about, right? So we are not going to consider the financing cost because financing cost is prohibited by the standard to consider. Number one, we are not going to consider the tax expenses or tax refunds, right? Because that item is also specifically prohibited or excluded by the Ind AS 36. And the lastly, future restructuring, because I explained you that whatever the management has the plans in the future, those are future plans and not the ground reality today. And we are calculating the cash inflows and cash outflows basis on the reality today and not the future expectations, right? So all those future expectations are also to be ignored, right? And the related expenditure too. Now, the cash flows, inflows and outflows are presented in the below nominal terms. They include a 3% per annum of the forecast price increase, right, in line with the inflation, and the cash flows are discounted using the discount rate of 8% that is also adjusted for inflation. So that we will discuss later. Now, first of all, let's develop the matrix. So first of all, whatever is my quantity. So first item is the quantity. So I'll start with this presentation, yearly presentation, right? And then I will populate the quantity, right? I think this everybody has calculated correctly. Then I will populate the price in line with the inflation, and then I will estimate the cash inflow, right? So I will calculate the cash inflows first, right? Then I will start populating the cash outflows. right? So again, the cash inflow of 80,000 as the terminal value. And then I will start populating the cash outflows. So cash outflows, I will calculate number of units same divided into my cost of goods sold, which we have calculated, right? Cost per unit. Here it is 160, 162, 165, 168, and 171. Then I will calculate estimated cash outflow A into my, E into my F, right? So this is the cash outflow, and this 50,000 is the repair maintenance expenditure, which is specifically given in the question that will be incurred, right? Now, total estimated cash outflows I have computed, right? So I have computed the total estimated cash inflows. I have computed the total estimated cash outflows, and then we will calculate the net cash inflows, right? So these are the net cash inflows, right? Now, until here, there must be two items which I would like to talk about. Number one, can't we do, instead of calculating or spending so much time on these calculations, can't we simply deduct the cost of goods sold from the selling price and simply do the one line calculation of the net cash inflow? How many of you were thinking to do so? You were thinking, but if you do that way, although you might be correct in your answer, but you will lose the marks for sure in the examination, because standard clearly asks you to calculate the cash inflows, then the standard asks you to calculate the cash outflows, then the standard asks you to calculate the net cash inflow out. Okay, so if you are going to apply the shortcut, simply or directly arriving at the net cash inflow or cash outflow, then you would be mistaken. Why it is so? Because cash inflows might be having certain different types of adjustments. For example, the terminal value in a different year. Cash outflows might be having a different type of adjustments. For example, repair maintenance expenditure in a particular years or multiple years with a different amount number. There might be few more inflows and outflows related items which are not present in this question, luckily, but they might be present in your examination question, right? So you will end up doing unnecessarily adjustments here and there, and the chances of mistakes are high, right? So first of all, the standard simply requires the step-by-step approach. So calculate the cash inflows, calculate the cash outflows, calculate the net cash flows, apply the discount rate, right? Separately, right? Even if you spend 2 or 3 more minutes in the examination, don't run on, shortening your presentation requirements unnecessarily to save the time, right? Okay. Now, since we are done with the calculation until the free cash flow, now we will simply apply the discount rate. Now, why the discount rate 8% is being applied here while it is being given at 10% in the question? Tax impact, right? So 10% is the uh, uh, gross rate. We have to calculate as the pre-tax basis, the discount rate, right? Since the future cash flows are estimated on a pre-tax basis, the discount rate is also determined on a pre-tax basis. How to do that? How you are going to calculate the pre-tax discount rate from the post-tax rate given in the question? So what was the tax rate? Hmm, tax rate was 30%, right? So can you calculate how you are going to calculate the pre-tax rate? It is given in the question, you mean to say 8%? I thought it was given in. Okay, so pre-tax is given. So if the pre-tax rate is given 8%, good. But if it is not, then you might need to calculate that, right, on your own, right? Is that clear? Okay. So 8% is the discount rate. Now we will apply the discount rate and we will compute the discounted cash flow. And lastly, the present value, 20,73,169 rupees, right? Is that clear? So pre-tax rate you need to calculate if the tax rate is given in the question. In the case tax rate is also not given in the question, then you can simply assume or you can quote the assumption that the discount rate is assumed to be pre-tax rate if nothing is mentioned in the facts of the question, right? And if the tax rate is given, then you can calculate. Clear? So if the pre-tax rate is not given, right? So you will calculate it if the tax rate is given. If the tax rate is also not given, then you can simply assume that whatever the discount rate is given is, the pre-tax only. So tax rate is generally given in the question, right? One minus tax rate, right? That calculation you can perform. Okay, so that was it. Maybe it's a time to have a break, or you want to do the question number 3. What is your take? So let's have a 10 minutes break, I think, and then we will pick up the remaining questions. So please be back by 8:47 sharp. Break started, Ashokji. Okay. So the next question, let's start with question number 3. On 1st of January, year 1, entity Q purchased a machinery costing rupees 2,40,000 with an estimated useful life of 20 years and the zero residual value, right? So 2,40,000 is the purchase price. 20 years is the useful life. Residual value is zero. Depreciation is provided on SLM basis. The asset had been revalued on 1st of January year 3 to 2000 to 2,50,000, but with no change in the useful life. So useful life remains same. On 1st of January year 4, an impairment review showed the machine's recoverable amount to rupees 1 lakh and its estimated remaining useful life to be 10 years. Calculate the carrying amount of the machinery on 31st December year 2 and the revaluation surplus on 1st of January year 3. The carrying amount of the machinery on 31st December year 3 immediately before the impairment loss on 31st December year 4, and the treatment and the depreciation charge for 31st December year 4. So these are the 4 requirements the question has casted on us, right? So very, very small question, right? Just a matter of few calculations, which are also easy to do, right? So would you like to try it, or should I discuss the solution straight away because uh, it is very simple? Okay, you want to try? Okay, go ahead. I'm giving you 3-4 minutes. Just do the calculations carefully and post the answer in the chat box. So carrying value year 2 is 2,16,000, depreciation 12,000 per annum. Okay. And how much is the impairment loss? Revaluation surplus 34,000. Okay. So impairment loss, you are saying 136,111 in the year 4 and have to adjust against the surplus of 34,000, which you have recognized as a revaluation surplus. Okay. So let's see. Conceptually, you are looking right. Let's see your calculations as well. Uh, First of all, we will calculate the carrying amount of the machinery at the end of the year 2, right? So cost of the machinery is given in the question 240 and depreciation is 24,000. Why? 240 divided by 20, right? Because residual value is given in the question as 0, right? So the entire value divided by the 20 years, 24,000. So 216 would have been the carrying amount at the end of the year 2, right? So at least this is correct. Then the carrying amount of the year 3 we will also calculate. How do we calculate? 216 is the carrying amount and the revaluation done and the revalued amount is 250. So the revaluation surplus of 34,000 would have been recognized in the OCI or the P&L. Where did you recognize this revaluation surplus? Can you tell me the journal entry of this? What is the journal entry to recognize this revaluation surplus? India 16. So India 16 says whenever there is an upward revaluation, it has to be recognized in OCI, correct? Yes or no? Yes. And if there is a downward revaluation, then it will be recognized in P&L always, correct? And also there is one more rule book in India 16, if you are able to recall. If the asset had been previously revalued, right, and it was upward revalued in the previous year, now it is a downward, then first of all, the downward revaluation or the loss will be adjusted against the previous upward and the remaining to the P&L, right? And the same logic applies if it was downward earlier and now upward, right? So generally the upward revaluation goes to the OCI provided there is no downward revaluation in the prior years for the very same asset, correct? So that's the complete rule book of Ind AS 16. Now going by that rule book, we will record this OCI in OCI, correct? Perfect. Now we will calculate the impairment loss now. So when the machinery is revalued or the year January 1 to year 3, depreciation is charged on the revalued amount over its remaining expected useful life, right? So, sorry. On 1st of January, the revalued amount is how much? 2,50,000. And what is the remaining useful life? 18 years because 2 years have already passed. So revised depreciation you will calculate first, right? And revised carrying amount you will also calculate 236,111. Then you will compare this carrying amount with the recoverable amount given in the question 1 lakh. So the revaluation loss will be 136,111. So have we arrived at impairment loss correctly? Let me see. 136,111. Correct. Okay. So this is the impairment loss. So this calculation or this aspect is very important to keep remember. So sometimes what happens, we miss to recalculate the revised carrying amount, which would eventually be compared with the recoverable amount, and hence we end up calculating the wrong impairment loss, right? So whenever there is a revaluation along with the impairment in the question, right? So it means you need to be extra careful in calculating the carrying amount first, right? The right carrying amount, which will be matched up with the recoverable amount, right? So impairment loss is 136,111. And now 34,000, the original revaluation was taken to the OCI and now we are getting a loss. So 136,111 minus 34,000, the remaining 102 will be recorded in the P&L, correct? And this 34 will be reversed from OCI. Yes or no? So this is the, again, a point to be noted always, because in the examination, if we do the right calculations, we calculate the right impairment loss, but we did not calculate the right impact on the PNL and the OCI, then also we will lose at least some marks, right? So as per Ind AS 36, whenever there is an impairment loss and the asset has been previously revalued and the revaluation surplus was sitting in the OCI, then first of all, we will adjust the impairment loss against the OCI and the balance, if excess, will go to the PNL. That is the rule book given by Ind AS 36. Right. So in Ind AS 36, it is clearly mentioned that if the asset which was previously upward revalued, for which the revaluation surplus is sitting in OCI, is now tested for impairment and there is impairment loss, then impairment loss, first of all, will be adjusted against that revaluation surplus of the past years. Once that is adjusted completely, the remaining, if any, leftover will go to the PNL. So please note down these key learnings in some notes somewhere so that you can quickly revise those key learnings in your short revision examination time, because you will not have the luxury of time to do all these numericals on that very day, right? Or 1 or 2 days before the examination. So note down these key learnings, whatever you are learning from these practicals, in a separate notepad so that you can quickly learn those or revise those, because all the numericals cannot be done in 1 or 2 days, right? Now, lastly, the last requirement of the question was to calculate the depreciation and the for after the impairment loss is charged. So now the new carrying amount stands 1 lakh, remaining useful life 10 years. So 10,000 would be the depreciation charge now onwards in the books of accounts. Is that clear? So question was easy, but gave us key learnings, right? Revaluation surplus needs to be adjusted against the impairment loss first. Remaining will go to the P&L. So that's the key learning. Another key learning from this numerical is to calculate the correct impairment loss. Always focus upon in matching up with the right carrying amount. The right carrying amount doesn't always mean the carrying amount given in the question. You might be required to calculate the carrying amount on that very date for which you are computing the impairment loss, right? Which might not be directly available in the question, that you need to derive like we do in this question, right? So these are the key things which we always keep in mind, right? Right. So this is the question. Question is very small, but it was power packed with some key concepts, practical application of the key concepts of Ind AS 16 and Ind AS 36 together, right? And that's the beauty of these questions. If they or similar questions comes in the examination, so it will give you an edge if you practice them well. Okay, next question. Question 4. On 31st March 2001, Vision Limited acquired 80% of the equity shares of the Mission Limited. So who is acquiring? Vision. So Vision is the parent company, Mission is the subsidiary company. Vision has acquired the 80% stake of the Mission for how much? 190 million rupees. The fair value of the net assets of the Mission Limited that were included in the consolidated balance sheet of the Vision Limited on 31st March 2001 were 200 million. So fair value of the net assets. What do we mean by net assets? Net assets means assets minus liabilities. That is called net assets. Net assets fair value on the date of the acquisition were how much? 200 million. It is the group's policy to value the non-controlling interest in the subsidiaries at the date of the acquisition at its proportionate share of the fair value of the subsidiaries' identifiable net assets, right? So at the proportionate share of the fair value of the net identifiable assets, NCI will be recognized. What do we mean by NCI? Non-controlling interest. So in the IGAP, we used to call this minority interest, right? In the NDS, minority interest word is not the right word. The right word is the non-controlling interest. And be mindful in the examination, never use the word minority interest anywhere on your examination sheet, right? Always use the word NCI or the non-controlling interest, right? Okay, so the 20%, remaining 20%, which is not owned by the Vision Limited, is the NCI. On 31st March 2004, Vision Limited carried out its annual review of the goodwill on the consolidation of the Mission Limited and found the evidence of the impairment. So when the Vision Limited on 31st March doing the annual review of the goodwill while doing the consolidation of the Mission Limited, it found some evidence of the impairment. No impairment had been evident when the reviews were carried out as at 31st March 2002 and the 2003. Right. So in the prior years, there was no evidence, but in 2004, there are certain indicators or evidences that there might be some impairment. The review involved allocating the assets of the Mission Limited into three cash generating units and computing the value in use for each unit. So subsidiaries assets are categorized into three CGUs, right? Unit A, Unit B, Unit C are the three identified cash generating units of the subsidiary, right? And in those, what all assets are present? Intangible assets, property, plant and equipment, and current assets. Current assets are like debtors or inventories, etc., right? Then the total of these assets are given in the question, right? And value in use also given straight away to you in the question for these assets. So you don't need to calculate the value in use on your own. It was not possible to meaningfully allocate the goodwill on the consolidation to these cash generating units, but all other net assets of the mission are allocated in the table shown above. The intangible assets of the mission limited have no ascertainable market value, but all the current assets have a market value that is least equal to their carrying value. The value on use of the mission limited as a single cash generating unit on 31st March 2004 is 350 million. Discuss. So always focus what is the requirement. Discuss and compute the accounting treatment of the impairment of the goodwill as per Ind AS 36, right? So you need to compute the impairment of the goodwill, right? And you need to discuss in your solution. Okay. So I'm giving you again few minutes to try on this, right, quickly, and then probably we will discuss the solution. Okay. So you are saying goodwill is 30 million. Okay. Manish is saying goodwill is 40 million. Okay. So let's see. The goodwill on consolidation of the Mission Limited is recognized in the CFS consolidated balance sheet of the Vision Limited is 30 million. How it is arrived? 190 million was the fair value of the net assets on the acquisition date, right? Given in the question, and it was how much? 80% of the 200 million, right? So this can only be reviewed for the impairment as part of the cash generating unit to which it relates. Since here the goodwill cannot be meaningfully allocated to the units, the impairment review is in two parts. So that we will come later, right? But goodwill calculation 30 million is clear to everybody. 200 million into my 80% minus 190 million. So 200 into my 80% is how much? 160, right? And 190 million, the price is paid. So 190 is paid while the fair value of the net assets received is 160. So 160 will be deducted from 190. So 30 million is the goodwill recognized on the acquisition date. Is that clear to everybody? Correct? Perfect. Now, Unit A and C have the values in use that are more than their carrying values. However, the value in use of Unit B is less than the carrying amount. This means that the assets of the Unit B are impaired by 24 million. That is 90 million minus 66 million. This impairment loss will be charged to the statement of profit and loss. Let's see the calculations below. So, impairment, sorry, intangible assets. What is the value of the intangible assets? Existing 10 million, property, plant and equipment 50 million, and current assets 30 million. Total was 90 million, right? For the unit B, as given in the question. Here it is, right? Correct? So for the unit B, these were the existing values, right? And the impairment loss, which will be allocated, is 24 million on these basis on the pro rata. So that we will calculate, and then the revised amounts will be for the unit B carrying amount would be 6 million, 30 million, and 30 million. How? On current assets, are we able to recall the rule that we are not going to allocate any of the impairment loss, right? So on current assets like debtors, inventories, we don't allocate any of the impairment loss, right? So since we don't allocate anything on the current assets, so impairment loss is nil. So carrying amount remains constant, and the remaining impairment loss, that is 24 million, is allocated in the pro rata or to the intangible assets and the PP&E, right? Okay. Now let's calculate the impact of impairment review on the carrying values. So unit A's carrying values was 1670. Unit B, the revised carrying value is 66, and unit C is 100. So total is how much? 373.5 million, right? And goodwill 37.5. How it is coming? So my goodwill was how much? 30 million, right? But this 30 million is basis on the proportionate share of the fair value of the net assets, right? So in the question, if you, I am not sure if you paid attention to this line. It is the group's policy to value the non-controlling interest in the subsidiaries at the date of the acquisition at its proportionate share of the fair value of the subsidiaries identifiable net assets, right? So NCI is fair valued at what? Proportionate share of the fair value, not the full value, right? So if we calculate the full value, right, of the goodwill, so how it will be done? 30 million, which was against the 80%, right? So 30 divided by 80%. So it will give you how much? 37.5, million? Yes or no? So it will be the full value of the goodwill, right? So out of 37.5, 30 million belongs to the parent company and 7.5 million belongs to the non-controlling interest. Is that clear? So at entity level, the total goodwill is how much? 37.5 million. 30 million pertains to the parent for 80% share and 7.5 million pertains to the NCI for 20% share, right? Now, the impairment loss, how it will be arrived? So 37 is my 37.5 is my goodwill. Unit A is 170, unit B is 66, and unit C is 100. So total value is 373.5 million, right? And revised values. So entire impairment loss will be allocated to the goodwill only. So revised values will remain same. So 170 million for the unit A, 66 for unit B, and 100 for unit C. So 350 will be the total, while impairment loss is accounted for against goodwill itself, and the 14 will be the remaining balance of the goodwill. So the impairment loss of 23.5 million is all allocated to the goodwill, because always this is the rule book as per India's 36. Whatever the impairment loss we have, we will allocate it to first goodwill. And if after eliminating the goodwill, there is still anything left in the impairment loss, then that will be allocated on a pro rata basis of the carrying values of the remaining assets, right? So leaving the carrying value of the individual business units shown in the table immediately above unaffected, right? Now, consolidated financial statements will be recognizing the goodwill, or it will be the standalone financial statement, only the consolidation. So standalone financial statements never has the goodwill in the books, right? It arises only when we do the line by line consolidation of the subsidiary, right? So in the consolidated financial statements, the goodwill that is recognized based on the 80% interest. So the loss that is actually recognized is 18.8 million. That is 23.85 million into my 80%. So closing goodwill figure will be 11.2 million. Are you able to get this adjustment? Because in our books, we are having 80% of the holding, 20% belongs to the NCI. So the NCI's share of the goodwill or NCI's share of the impairment loss will be adjusted in the NCI figure. So remaining will be adjusted in the parent share. So in the parent's share, how much finally the adjustment would be? So 30 million was the goodwill for the parent, right? And the total impairment loss, which we have recognized, is 23.5 million against the 37.5, right? So remaining left is 14 million. Now, out of this 23.5, only 11.2 million pertains to the parent, right? So 30 million was the initial goodwill. After write-off, it remains 14 million. And of the 14 million, 80% is the parent's share. So how much? 14 into my 80? 11.25 million. So 11.20 million. So 11.20 million is the share of the goodwill of the parent company, which will be appearing on the consolidated financial statements in under the goodwill. Because the NCI's share of goodwill will be subsumed within the calculation of the NCI itself, non-controlling interest. Is that clear? NCI's share of goodwill is not going to be appearing on the consolidated financial statement or the balance sheet. On the balance sheet, only 11.2 million goodwill will be appearing after the impairment loss recorded. Is that clear? Yes, no? Right. So India's 103 business combination is actually being applied here. hiddenly, right? So although the question revolves around the impairment, but it requires the application of India's 103 as well, right? So let me quickly do a recap of India's 103 for your convenience. So 103 says that, boss, you need to determine the fair values of all the assets and liabilities you have acquired or assumed in a business combination on the date of the acquisition, right? Once you determine the fair values of all the assets and liabilities, right, then you match up the total or net of the fair values of the assets and liabilities with the purchase consideration you are paying for to acquire, right? So fair value of the assets and liabilities matched up with the purchase consideration, the remaining goes to the goodwill. So doing so, the goodwill has been calculated in this question, which was sitting at how much value? 30 million, right? But 30 million was pertaining to the 80% acquisition, not the 100% acquisition. So we did a gross up of the 30 million to arrive at the full goodwill at the entity level, right? So 30 million goodwill, which was initially calculated, was belonging to the parent, right? Now it needs to a gross up, right? So when we do the gross up, so 30 divided by 80%, we end up calculating 37.5 million, the total goodwill, right? Out of this, 30 million pertains or belongs to the parent and 7.5 million belongs to the NCI, which will eventually be adjusted in the NCI calculation automatically. Getting my point? Now, for the purpose of doing the impairment testing, so do you know that we need to do the apple to apple comparison? What do we mean by apple to apple comparison? What is apple to apple comparison? Okay, let me quickly explain it. Okay, so let me find some white space. Here it is. So please pay attention. This is the important aspect I'm explaining to you. So this is the CFS. Okay, this is the parent company balance sheet, right? And this is the subsidiary company balance sheet, right? Now suppose here are the assets, right? So assets are PP&E and say debtors and say inventory. Suppose these are the three assets. Say 80, 20, 10, 110. Okay, for the sake of simplicity. Now the parent is, suppose, same assets, PP&E, debtors and inventory. Okay, suppose 120, 50 and 30. What is the total? 0, 200. Correct? So this is the total. Now, if you are preparing the consolidated financial statement and your parent has acquired 80% share of the subsidiary, now how do you do the consolidation? So for the purpose of consolidation, so you will doing PP&E 120 plus 80 into my 80%. Is it so? Or you will be doing the 80 fully? What is your take? 80 fully, line by line consolidation. We don't apply the percentages, right? So when we compare, when we do the consolidation line by line, so we don't apply the percentage here of us. We simply add up whatever the value of the assets or liabilities are sitting in the subsidiary balance sheet. Correct? Yes or no? That's the concept. Now, when you calculate or prepare the present consolidated financial statement, so PP&D will be 120 plus 80. How much? So PP&D will be 120 plus 80, 200. Debtors would be how much? 50 plus 20, 70. And inventories would be how much? 30 plus 10, 40. Right? How much is the value? 0 and 310. So 310 would be your assets, right? Now, in this case, assuming these consolidation has been done assuming there was no goodwill. Suppose there was goodwill as well. So from parent share, goodwill was how much? 30 million. And subsidiary NCI's share was how much? 7.5. Now, if I go and present the goodwill here, then what would that goodwill be? 30 million or 37.5 million? What do you think? Full goodwill on the consolidated balance sheet? So the goodwill will come 30 million because the question says we are calculating the NCI on the proportionate share, right? So NCI's value will automatically be adjusted for the 7.5 million, right? The 20% share which NCI you would be computing, right? But because you are testing the impairment testing, you are doing the impairment testing for all these assets, right, of the subsidiary, which are divided into three units, unit A, B, and C taken together. So for these, you need to gross up the goodwill, that is 30 million plus 7.5 million, 37.5 million, and then unit A, B, C, and then you calculate the carrying recoverable amount, match up with the recoverable amount, and then you arrive at the impairment loss. Then that impairment loss will be eventually allocated on these goodwills first, and then if left over to the remaining assets. So that's the rule. So what do we mean by apple to apple comparison? So for doing impairment testing, so we have to match the carrying amount with the recoverable amount of the assets. Now, carrying amount, if suppose having a 30 million goodwill, so it means 7.5 was missing. Yes or no? So we added up 7.5 manually here and then arrived at the right carrying amount because the recoverable amount, which we eventually calculate basis on the fair value of the subsidiary if we sell in the market or the value in use, that is the future projections, it is being calculated assuming all the assets are fully utilized for the business purpose. So recoverable amount is factoring in anyway the goodwill and the other assets together, while the carrying amount is having by virtue of the accounting policy choice only the 30 million on the balance sheet. So that's why 7.5 million we have manually added before we actually do the comparison of the carrying amount with the recoverable amount in order to arrive at the right impairment loss. Getting my point? So that is called the apple to apple comparison. Because in my books, the goodwill is not being shown up at 37.5, rather it is being showed up at 30 million. So I have manually considered that for the purpose of comparison only, not for the purpose of accounting. Is that clear? Correct. So the key learning from this question is we will be doing the apple to apple comparison. What do we mean by apple to apple comparison? That is the carrying amount of the assets will be compared with the recoverable amount of those assets. What do we mean by the carrying amount of those assets? If there is any goodwill, because for all other assets, anyway, the carrying amount is sitting at its full value. It is only in relation to the goodwill where we adjust the NCI, right? So for the goodwill, if any, we need to gross up before we compare the carrying amount of the assets with the recoverable amount. That's the key learning from this question. Rest, everything was straightforward. Is that clear? Perfect. So I hope you noted this apple to apple comparison learning from this question. So all these questions are, very unique in terms of the learnings, right? So until now, we have not done any question where you felt that, oh, this is the same which we have done in the previous question, right? So all these questions are very uniquely designed by the institute, right? For greater concept and practical application of those concepts. Perfect. Let's do the last question for the today, question number 5. At 31st March 2001, assets of a CGU are being reviewed for impairment. The carrying value of the CGU's net assets is 65 lakhs. excluding any restructuring provision. And the remaining useful economic life of the recognized asset is 8 years. So 8 years is the economic useful life. 65 lakh is the net assets carrying value, excluding any restructuring, right? Management's approved budgets at 31st March 2001 included restructuring cost of rupees 3.5 lakh to be incurred in 2002. The restructuring is expected to generate cost saving of rupees 1 lakh per annum from 2003 onwards. Formal budgets have been prepared for 3 years to 31st March 2004. A zero growth rate is assumed because market conditions are extremely competitive, and this is expected to continue for the foreseeable future. The future cash flows estimates are as follows. So, future cash estimates of cash flows with restructuring, without restructuring considerations are given, right? So, for the year 1, 2, 2, 3, 3, 4, 4, 5, 5, 6, 6, 7, 7, 8, and 8, 9. So all these cash flows are given with and without restructuring, right? Please pay attention. With restructuring and without restructuring. So cash flows are given, right? In 2002, the net cash flows without restructuring 870 exceed the net cash flows with restructuring 5 to 0 by the amount of the restructuring cost 350, right? So in 2002, where it is 2002, here it is. So 520 and the 350, the delta is 350, right? So this is the amount of restructuring cost being incurred or expected to be incurred by the management in this year, right? The future cash flows, which exclude inflation, have been discounted at the rate of 4%. For simplicity, it has been assumed that the cash flows arise at the end of the year. So 4% is the discount rate given. Compute the impairment losses as at March 2001. When restructuring cost is recognized in the financial statements as at 31st March 2001, and the restructuring cost is not recognized in the financial statements as at 31st March 2001. Okay, so before you actually start doing the calculation of this numerical, one key concept I would like to revise so that you are not mistaken, right? In this, the key concept is restructuring costs are to be avoided if they are not a reality. So if restructuring cost is not yet incurred and is only planned by the management, then they are ignored for the purpose of this standard, right? If the management has actually started the restructuring and ended up incurring the restructuring cost, then only they are considered, right? So in the question, it is clearly asked that you need to calculate the impairment losses, assuming the restructuring cost is recognized, that is restructuring plan is executed, and assuming the restructuring cost is not recognized because the restructuring plan was not executed, right? So under these two scenarios, what would be the impairment loss? So as such, there is no much complications in this question because there are no such big adjustments, right? So you can simply do the calculation quickly and come up with the answer. I'm giving you a couple of minutes to try it once on your own. Let me know in case I need to come down on the page. Okay, I'm just coming down. So with restructuring and without restructuring, right? So first column is with restructuring, and this is without. Any luck with the answer? Yes. Any luck with the answer? Value in use with restructuring is 651,3995. Okay. Others, and without is 627,3956. Okay. Manish is saying with restructuring 65. 65.14 lakhs and without 62.73 lakhs. Okay, let's see quickly what is happening over here. So with is 65.14 and without is 62.73. That is absolutely correct, Manish, right? So I think your answer is correct. And Saminathan has arrived at without 62.7 rounded off. Okay. Okay. So I think calculations both of you have done it right. Right. So now let's understand how we are going to account for them. So first of all, provision for restructuring cost is recognized on 31st March, right? So what would be the entry for that? If the provision has been made for restructuring cost, the cost and the benefits of the restructuring are taken into account to determine the CGU's value in use. Here, the post-restructuring cost value in use is 65.14, exceeds the CGU's carrying amount 65 lakhs, less restructuring provision of 350. Hence, there is no impairment. Why? Because the carrying value was 65 lakhs minus 3 lakh 50,000. So 65 minus 3.5. How much? 61.5, correct? And because this is the carrying amount and we are having a 65.14 as the value in use, so which is higher as compared to the carrying amount. So there is no point in recognition of the impairment loss when the restructuring is taking place. Is that clear? Now, the question coming to your mind is how we are computing the impairment loss basis on the value in use only. Why we are not calculating the fair value less cost to sell, which is also needs to be calculated, correct? Anybody thought of this, that why we are not calculating the fair value less cost to sell and the value in use comparison higher of the same will eventually be compared with the carrying amount? Why we are only calculating the value in use in this case? No, the fact basis on the fact, you can say, because the facts of the question doesn't talk about any of the fair value, hence we cannot, right? That's right. But the technical aspect or the standards requirement about this is, if any of the parameter, that is whether it is value in use or the fair value less cost to sell, is exceeding the carrying amount, then anyway there wouldn't be an impairment loss for sure, whether we calculate the other parameter or not. Can I say this? Yes or no? So suppose if I have the fair value less cost to sell and I have the carrying amount and my fair value less cost to sell is greater than the carrying amount, then there wouldn't be the impairment loss for sure, because the rule given by Ind AS 36 is higher of the two, right? And if anyone is exceeding the carrying amount, then there wouldn't be any impairment loss. So standard says there is no need to calculate the other parameter if any one of the parameter which you have calculated in first place is higher as compared to the carrying amount. So that's why, that's the technical aspect of this. So certainly you can say that because in the examination hall, if the question facts doesn't say so, then how do we calculate? That's the right thing. But the technically there is no requirement either. Is that clear? Right? So that's why we are not focusing upon, and we are simply calculating the value in use basis on the facts given in the question and matching up with the impairment carrying value. And since there is no impairment loss, so we don't need to calculate the fair value less cost to sell in the scenario one. Right? What would be the entry? The entry would be, because management is incurring the expenditure of the restructuring and the restructuring is taking place. So restructuring provision will be debited to the P&L and the impairment loss will be nil, right? So only entry would be the restructuring provision. What would be the entry? Restructuring expenditure account debit to restructuring provision account, right? 3,50,000, 3,50,000, that would be the entry. Correct? Now let's come to the second scenario. So in this case, what is happening? No provision is being recognized for the restructuring, and hence the restructuring cost is not considered. So if no provision for the restructuring cost is permitted by the Ind AS 37, the cost and benefits of the restructuring also needs to be stripped out of the projections in determining the CGU's value in use. Here are the CGU values. 65 lakh is the carrying value, which exceeds the pre-restructuring value of 62.73 lakhs, right? Therefore, the impairment loss is 2,27,000. Now, in this case, your logic fits because you said that in the examination or in the question, if the facts are not telling us anything about the fair value determination or fair value less cost to sell, then how do we calculate? So in this situation, because the impairment loss is getting arrived basis on, the value in use, so we might be requiring to calculate the fair value less cost to sell as well in this case. But because of the absence of the facts in this question, we are not able to do so. And hence we are solely relying on the value in use only in this case. Is that clear? Because if we do calculate the fair value less cost to sell and suppose fair value less cost to sell comes higher as compared to the value in use, then my impairment loss will be different. Are you getting my point here? Correct. So impairment loss will be different if the fair value less cost to sell is coming higher as compared to what the value in use we have calculated, right? But because we don't have the facts around that, so we are solely relying on the value in use in this case. So in this case, we can say the question is silent, hence we relied upon value in use. But in the first scenario, when the impairment loss is not coming in the first place, there is no need either to calculate the fair value less cost to sell, even if the facts of the question are facts in the question are given, right? Conceptually. So in this case, what would be the entry? Restructuring provision. So anyway, we are not recognizing, right? So it will be nil and the impairment loss will straight away go to the P&L. Unless and until any of the revaluation surplus is sitting in OCI for this very asset in my balance sheet. Correct? So we all the time, we have to keep all the concepts in our mind because in the examination, we are expected to be, well versed with all the standards talking to each other, right? So we should be aware about Ind AS 16 requirements. We should be aware about Ind AS 36 requirements, right? So basis on that, we will be able to, give our solution or answer perfectly, right? So even if the impairment loss we have calculated right, and suppose there is a revaluation surplus given in the facts of the question, and we are not able to recall that, first of all, impairment loss needs to be adjusted with the OCI balance, then we might end up passing the journal entry through the P&L only, which will eventually uh, lose the marks, right? So all the concepts have to be remembered or recalled together, right? So practice more. Note down key learnings the way we have noted down today from these 5 questions and revise those, on a regular basis. That's the key. So with that note, we are done for the today's session. Now the forum is open to you. In case you want to ask any of the questions which you might have faced during your, practice or during your revisions or during your, concepts revision from the standard. Anything you want to ask? In case you want to ask, you can unmute yourself as well. Okay, it's blocked. Okay, let me unmute you.
In case, sir, good morning, students. So, in case students have any query, otherwise I can take 5 minutes to address the students.
Hello, ma'am. Good morning.
Hello, sir. Good morning. Good morning, students and students. I hope you are finding these LVRC's revisionary classes useful. And in case you feel that any all the schedule has been uploaded for the entire LVRC for financial reporting, in case you feel that any other standard you want me to cover it up, just let us know so that we accordingly plan the session. Okay. Okay. Okay, Manish, and we request both of you, Manish and Saminathan, to fill the feedback form for this LVRC session-wise. And in case you have any other queries or from Board of Studies, you can let us know. Okay. Uh, So students, I hope you are there in your WhatsApp group also. WhatsApp group is there for final. We have official WhatsApp group for final. You can join that also. The link is given. I hope both of you are there. And in case you are not there, just let me know. We'll provide the link to join that WhatsApp group. And also students, the questions which are covered in the session, these sessions cover the entire standard. Okay. Saminathan is there in the link. Okay. And Manish, hope you are also there. So the questions which have been covered in the class, these questions cover the entire standard and are important standards from the important questions from the perspective of examination. So you should understand and practice it after the class as well. Don't feel that in case sir have taught this, then you have studied this now. You do not require to practice it. Just do the revision of these questions as well. This will help you in to cover the entire standard, the concepts covered in the standard, and also for your examination purpose also. Okay. Besides, but this is not an exhaustive list. It is not that key only these standards are to be covered, and beyond that, you are not required to cover any other question. You have to practice other questions also. We'll be coming up with the RTP with new questions. So go through with that RTP also, and for past few attempt RTPs as well, because they carry new questions. Any question? I'm having some questions. Okay, Manish is also there. Okay. Okay, then students, in case you have any query, and do fill the feedback form. In case you have any query, then let us know. Otherwise, we'll wind up the session.
So I was telling exactly the same thing to everybody that these questions are very, good and designed by the institute, which covers almost all the key aspects of the standard in conjunction with other standards, so like India 16, property, plant and equipment. So this question certainly must have helped the students today to understand the practical application of 36.
Don't consider these questions to be a very inclusive list. You have to study beyond these questions also for this particular standard. We have tried to give whatever is possible in 3 hours, but there are some other questions also which requires your practice. Okay, especially the questions which are covered in the RTP with respect to the standard. Go through them also. Okay. So I think students don't have any session. We can wind up the session.
Perfect. So thank you for listening me patiently today and participating in all the responses, which made the interaction live. And I wish you all the very best for your examination. See you as a chartered accountant soon. Have a good day. Bye.
Bye. All the best, students. Bye bye.